We are trapped inside this fiat world in 1971 to now, and I think of that as a paperization of a liquidity crisis. And we had gold and silver as money for 6,000 years, and it spanned the agrarian age, the industrial age, we're in the digital age, and I think the fiat will blow up eventually. The only thing that's special about now is the whole world got rugged all at once. So, we're all sort of debasing ourselves to oblivion where, when one kingdom debased, they blew up really quick because, everyone ran to the gold-backed kingdoms.
But I think we're going higher just because you just look at the math. There's just way more demand than issued supply of Bitcoin or, existing overall supply in the marketplace. So we still maintain our price target between 180 and 200,000 by year end. And I think that's a cautious price target, by the way.
Big money is entering crypto, not just raising prices, but reshaping money's future. Bitcoin ETFs, led by giants like BlackRock, open doors for institutions, yet risk letting the system Bitcoin aimed to escape absorb and redefine it. Meanwhile, Bitcoin's $2 trillion value is only a tiny fraction of the $900 trillion traditional asset pool. With only 450 new coins minted daily, massive institutional demand looks incredibly bullish. However, this creates a new danger: centralization. If too few companies hold too much Bitcoin, they become the exact centralized gatekeepers Bitcoin was designed to escape, creating a single point of failure and undermining its core purpose. To understand this tension, we're breaking down insights from two key players: Anthony Scaramucci of SkyBridge, who is wildly optimistic on the price, and on-chain analyst Willy, who warns this institutional phase could be a Trojan horse. Anthony Scaramucci of SkyBridge Capital points out that while some early whales are selling, it represents a healthy change of ownership and consolidation. He sees the current influx of institutional investors through ETFs as a fundamental driver that is far from over. Based on this powerful supply and demand dynamic, he is predicting a bold year-end price target for Bitcoin between $180,000 and $200,000. Now, let's watch clips from Anthony Scaramucci's interview to gain more insight. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
Listen, there's been pain and euphoria in the Bitcoin markets over the last 5 years. I think what's happening now is lots of consolidation and institutional adoption. So if you went to a conference like this 3 years ago, it was mostly retail investors and CEOs working in the layer 1 blockchain space. Today, it's lots more institutional investors. So that's finally starting to happen. If you look at the numbers on something like the BlackRock ETF, the IBIT ETF, you can see now, Andrew, there's lots of institutions coming in. So what's interesting is that some of the whales have been selling. So I know I've seen your interviews with Michael Novogratz and the 80,000 Bitcoins that sold last month. And so there's a consolidation story happening. There's a change of ownership story happening. But I think we're going higher just because you just look at the math. There's just way more demand than issued supply of Bitcoin or, existing overall supply in the marketplace. So we still maintain our price target between 180 and 200,000 by year end. And I think that's a cautious price target, by the way. I think there are people that are way above us, those levels. But I just think it's a function of buying and only 450 Bitcoins being made by the network per day. They're all linked to Bitcoin, IBIT being the purest link to Bitcoin. I think what Michael has done is absolutely extraordinary, as evidenced by all of the copycats that are out there. And again, not just copycats for Bitcoin, but for Ethereum, Solana, Avalanche, and others. And so it's different strokes for different folks. Michael, you're probably getting a little bit more of a kick to your Bitcoin exposure. IBIT, I think it's a pure play, and I would just point out that places like JP Morgan will actually lend on IBIT, and so it's a very secure asset that people trust. I own a lot of Bitcoin and hold it in storage, Andrew, for myself and for SkyBridge. And so there's different ways to approach it. I think the institutions will likely go into the ETFs. And of course, there's a lot of institutions that, quote unquote, can't own Bitcoin that they end up owning Michael stock or synthetics like that. And also the state of Wyoming is announcing this morning their own stablecoin, so you can add that to the mix as well. Congratulations to the state. I just think that that's generally good. I share Secretary Besson's view of this, that that's generally good for the U.S. dollar. It means more treasuries, more short-term treasuries, demand for those securities. But I also think it's going to bring a wave of technological innovation. We, at our last conference in Bermuda, we did a drop of stable coins into people's phones where they could spend, I guess it was $100 at the different tourist shops on Front Street in Bermuda, and it worked beautifully. And I think you're going to get to the point where we're transacting using stable coins. It may bypass some of the credit card fees and some of the other ancillary third-party confirmation fees that we've charged historically in the marketplace. So I generally think it's very good. I think those companies will consolidate. And I think one of the discussions here at the Wyoming Blockchain Symposium is going to be about a central bank digital currency. And I stand with President Trump on that. I don't think we need that. I think it could be, from a libertarian perspective, too intrusive from a privacy matter. And I think the private companies are doing a great job in this area. And so I'd like to just stay in the private company realm as it relates to dollar-based stablecoins. If you look at the last legislation, there's no yield on the stablecoins, Andrew. So if you're converting dollars into a stablecoin, there's going to be a spread there for those guys naturally. I don't think the competition is going to impact that, unless we switch up that yield mechanism.
Meanwhile, Willy Woo sees this institutional phase as a necessary tipping point, but one filled with hidden risks. For Bitcoin to truly succeed and become a global monetary standard, it needs this massive inflow of capital from major investors. That's the tipping point. However, the way it's happening looks a lot like a Trojan horse. The biggest danger he points to is nationalization. He warns that if the US dollar weakens significantly, the government could feel threatened. History shows us what happens next. Just like with gold in the 1930s, the state could use incentives or force to gather a huge amount of Bitcoin into a digital Fort Knox. If that happens, they could effectively rug pull everyone all over again, going back to a fiat system and making a second attempt at Bitcoin much harder. He also talked about the copycat companies following MicroStrategy's lead. He says many of them are using risky, short-term debt to buy Bitcoin. If the market turns down sharply, many of them could face liquidation, causing a cascade of selling. This wouldn't just hurt them, it would create a wave of negative headlines that could damage Bitcoin's reputation for years. Another form of the Trojan horse effect. Let's hear directly from Willy Woo to gain more insight into this topic.
So you can think of Bitcoin as a little Pac-Man, and we'll be eating these little dots. Gobble, gobble, gobble. Now the big cheese, you're digging into that, right? So I think the tipping point, I think it really was a tipping point, was last year when the BlackRock ETF came on board and the high priest, Larry Fink, said, we're doing this ETF and now you can talk about buying Bitcoin for the rest of the traditional world, right? That encapsulates $900 trillion of wealth assets. Bitcoin at this point is $1 trillion. And we always hear talk about liberty, separation of money and state. That means that the government can't overspend and then tax everyone through dilution, effectively stealing from the poorest. That doesn't end until that Pac-Man gets big enough to displace the US dollar, flips gold, and becomes a monetary standard. And that's not going to happen until you get the large gatekeepers of capital opening up to Bitcoin and pouring that money in. It's a necessary step. With it comes risks. We can talk about the fragility of centralization. If big pools of Bitcoin get stored in one location, that might get nationalized and so forth. But that's a different discussion. This is always going to happen if we're ever going to, effectively change the way the world uses what we use as money. I don't think centralization around Coinbase and that being hacked is the danger. I think it's really the nationalization path, which happened with gold, and it's happened before. And if the US dollar is structurally getting weak and China's coming in, I think it's a fair point that the US might do, an offer to all the treasury companies, incentivize that. It could be then put into a digital Fort Knox, create a new, gold standard. You could then rug it like happened in 1971. It's all centralized around this digital Bitcoin. The whole history repeats again, and we're back to fiat again. And then now we're in this position where we tried this Bitcoin thing, but that didn't work, so it makes the second attempt harder. I think that is the centralization risk when it comes to a very big and powerful nation state.
So do you think it's more probable that the US may acquire an existing company with a lot of Bitcoin and treasury rather than holding their own treasury?
Yeah, I think that if you were say you wanted to get, say, 4% of the 4 million of the Bitcoins, you're going to buy it on the open market and drive the price to infinity, and Michael Saylor becomes probably the richest person alive, and therefore, well, let's say most powerful person alive because it's common stock held, or you're just going to do a share offer. And effectively nationalize in a very free market fair way. You've got this big bag of X million by then Bitcoin. You haven't run up the price, and then everyone who's just sold their MicroStrategy stock, let's say, now has to buy back their Bitcoins, and then it runs up. I think that would be the smarter way to do it. But just thinking about the dynamics of how would you get a big bag of Bitcoin and then create dollars trading off it, or backed by it, and then how do you rug that into fiat? I think that's a path that's been done before. Strategy is probably the most robust of these companies, and you see in this cycle everyone's following the model, but it's not the exact model. And we have to be careful of the risks that are being taken. Strategy. Originally, when they were doing the convertible debt, was I think it was a 5-year out debt, and so I think MicroStrategy might have been close to liquidation in the last bear market had the debt not been pushed out 5 years. So I see a lot of these companies now have quite short-dated debt using the older model of convertibles, where Strategy went to 8 to 12 years, and now they're doing the preferred stock. You look at Metaplanet, and they're doing this sort of hedge fund play where there's a hedge fund. They're doing a back and forth to simulate a at-the-market offering, to effectively simulate the ATMs that MicroStrategy are doing, but they're taking big tranches of debt, 300 million at a time, and then selling that into the market to replenish, to then pay off the debt. If the market turns on that at the wrong time and they cannot do this market operation, you're going to get liquidated. And it's not 4-year debt, it's not 8-year debt, it's immediate debt. And so you really need to look at the copycats and look at the dangers in the debt structuring and liquidation risk. And my opinion of Metaplanet is that they are quite expert at timing the market. Maybe that's the game that they played. They absolutely bought the bottom wick of the last major dip and unloaded almost 300 million in that one buy. So maybe they're proving they can time the market, but that's what you're buying. You're buying a treasury that has opted to time the market, and they think they can unwind the debt at the top from the looks of how they've structured things. And, there's a lot of these treasury companies, a lot of paperwork to work through. You want to know what you're buying. There's risks in it. MicroStrategy is the blue chip. Very, very robust. Still risks, obviously, with everything. My concern is the copycats that aren't doing it at the same level or have, how many of these guys can offer preferred stock? What are their options? A lot of the latest vogue is to really start small and run up the leverage, get the yield right up and grow fast. We're tail end of a bull market right now. So I think a lot of people are going to get hurt, and we'll have massive MNAV compression. We're going to have liquidations of some of the weakest treasury companies, and we'll see who's going to survive and what's going to break. over the next bear market, and I'm wondering about what the commentary from TradFi will be as I look at those Bitcoin or crypto people, look what they did there and look what broke, and another cycle of jokes on us. We are trapped inside this fiat world in 1971 to now, and I think of that as a paperization of a liquidity crisis. And we had gold and silver as money for 6,000 years, and it spanned the agrarian age, the industrial age, we're in the digital age, and I think the fiat will blow up eventually. The only thing that's special about now is the whole world got rugged all at once, so we're all sort of debasing ourselves to oblivion where, when one kingdom debased, they blew up really quick because, everyone ran to the gold-backed kingdoms. So this will blow up. And then what replaces gold? And it's not going to be gold again because it's no longer scarce. Not in 100 years, not 1,000 years. I mean, gosh, who knows what technology we'll have then? And it's only a few decades away to mine asteroids, given the pace of that technology. So you have to secure the scarcity, the ledger, with something that grows with technology, and that's energy. And Bitcoin's had the 5% adoption. It's very hard to catch something like that. For money, there's only two properties of money. One is it's accepted, and number two, it's secure and robust, and that was the scarcity element of gold. And all the other stuff was just people thinking about gold. It should be divisible, it should be durable, and that was us using atoms to secure the ledger, but that doesn't apply anymore. And so you pan this forward 1,000 years of technology, it's got to be an energy coin, and we've got one, and it's reached hundreds of millions of people already, soon to be 1 billion. Well, I think it's ironic because the bank shut down banking for the exchanges back in early days in 2013, 14, roughly when Tether came to be, because there was no banking to be had, so they were the de facto banking, and they got so big that they're now on track to displace China's buying of treasuries when Bitcoin hits $1 million, and therefore the US government becomes dependent on Bitcoin. Because how it works is there's an order book on the exchange. You got Bitcoin on one side, you've got US dollars on the other side, but it wasn't US dollars, it was Tether. So as the liquidity increases, there's more and more expansion of Tether to trade for it. And now, it's at the point where it's displacing the largest nation states to buy the US treasuries.
Anthony Scaramucci and Willy Woo paint a picture of Bitcoin's present and future that is both exciting and dangerously complex, representing two sides of the same institutional coin. Scaramucci's bullish 180,000 to 200,000 year-end price target isn't just speculation. It's driven by a straightforward and powerful observation. Institutional demand via ETFs is finally here, creating a fundamental shift in ownership from early whales to major funds. He sees the current market activity, including the selling of 80,000 bitcoins last month, not as a warning sign, but as a healthy consolidation and change of ownership story. For Scaramucci, the math is undeniable. With only 450 new bitcoins created daily against massive institutional appetite, the supply-demand dynamics overwhelmingly support higher prices. Wu agrees on Bitcoin's ultimate potential, but forces us to confront the profound risks that come with this very adoption. He argues that if this institutional phase leads to extreme centralization of Bitcoin holdings within a few companies, ETFs, or exchange custodians, it recreates the very single points of failure Bitcoin was invented to destroy. His nationalization warning is particularly stark, drawing direct parallels to the 1930s gold confiscation. He suggests a modern digital Fort Knox scenario where the government could acquire massive Bitcoin holdings not through open market buying, which would send prices to infinity, but potentially through incentivizing or even pressuring corporate treasury companies. A sophisticated rug pull that could undermine the entire experiment. The both of them present a tense balancing act between these perspectives. Scaramucci's bullish price prediction appears fundamentally sound in the short to medium term because the institutional demand is real and measurable through ETF flows. These new on-ramps are indeed getting bigger and more efficient. However, Wu's warning serves as the crucial counterpoint that every Bitcoin holder must consider. This entire growth phase could be undermined if it leads to a system where Bitcoin becomes just another centralized asset class, as fragile and controllable as the traditional system it was meant to replace. The incredible irony is that the very tools boosting adoption, ETFs, corporate treasuries, and leveraged Bitcoin holding companies, could also represent its greatest vulnerability, especially when many copycat companies are using risky, short-term debt strategies that could liquidate during a downturn. The path forward is clear, but difficult. The institutional phase represents both a tipping point for price appreciation and a potential Trojan horse for Bitcoin's foundational values. The only way to ensure Bitcoin ultimately fulfills its mission of creating a decentralized, robust monetary network is to remember the first rule: hold your own keys. The new institutional on-ramps are getting bigger and more convenient. However, the final destination for meaningful Bitcoin ownership must always be self-custody. If the ecosystem forgets that core principle in the excitement of rising prices and institutional validation, we risk winning the price battle but losing the war for a truly decentralized future, exactly the outcome that would validate Wu's most worrying predictions. Thanks for watching, and don't forget to like and subscribe.